Okay, so let's get right into it. There's this incredibly common and frankly frustrating situation for so many investors.
I know exactly what you're talking about.
You've done everything right. You've diversified. You've got maybe 15 different tickers in your account, some big tech, a few popular ETFs, maybe a fun bet on a commodity. You feel covered.
You feel safe.
And then the market sells off hard and you look at your screen and what do you see?
Everything drops. All at once, together.
Exactly. And you realize you don't have a portfolio. You just have a pile of tickers.
It's what we call one big bet with extra paperwork. The failure there isn't that you picked bad assets, not necessarily. It's that you didn't have a system, a repeatable pipeline for building the portfolio itself.
And that's the whole thesis of this deep dive. We're moving away from picking stocks based on, hype or a good story,
Right.
and toward building an actual team of assets where every single position has a job. This one's for growth, this one's for defense.
A genuine diversifier. And we're going to give you that system. It's a concrete 5-step methodology that you can run.
We'll show you how to define what's eligible, how to filter for strength, how to check for quality, and then, crucially, how to kill that hidden concentration.
And finally, how to size your positions based on risk. This is really how you go from chaos to having actual control.
All right, let's start at the top. Step 1, defining the universe. This sounds simple, but it's pretty foundational.
It's critical. Your investment universe is simply the complete list of assets you are willing to consider. That's it.
So at this stage, we're not judging quality at all.
Not at all. The goal here is coverage, not quality. You are just defining the sandbox you're going to play in. This is where your beliefs live.
So if I've been reading about a certain tech trend, I throw those stocks in. If I like a few ETFs, they go in. Maybe some ideas from, say, 13F filings.
Perfect. Anything you're willing to own goes on the list. Stocks, bonds, commodities, ETFs. Because if an asset isn't in your universe to begin with, it can never, ever compete for your capital.
Okay, so now we have this big, messy list. What's next? We need to bring some order to it.
Immediately. This brings us to step 2, the trend filter. We need a non-emotional way to just remove the weakest candidates right away.
And we're not trying to forecast the future here.
Absolutely not. Forecasting is a guessing game. We want rules. And the simplest, most effective rule for this is the 200-day simple moving average, the SMA.
A classic.
It's a classic for a reason. It cleanly separates assets in long-term healthy uptrends from those that are just grinding lower.
So walk me through the rule itself. How does it work?
It's a simple gate. If an asset's price is above its 200-day moving average, it's generally in an uptrend. It's eligible. It gets to move on to the next step.
And if it's below?
It's excluded immediately. You don't argue with it. You don't hope for a turnaround. It's just out. It's in a structural decline.
Now, I can already hear the pushback. People will say, but that's a lagging indicator. I'll miss the bottom.
And that's a totally fair point. But you have to ask yourself what the goal is. The goal isn't to be a hero and catch the absolute bottom of a falling knife.
Right.
The goal is to avoid the soul-crushing, capital-destroying experience of riding a stock down 50% while you wait for it to turn around.
So in this context, the fact that it's a lagging indicator is actually a feature.
It's a feature, not a bug. It confirms the wind is at your back. Getting out of the way of a long-term downtrend is one of the most important things you can do to preserve your capital, and capital preservation is everything.
So we've used that 200-day SMA. We've basically established the guest list for our party. We know which assets are going up. But now we have to ask the more important question. Are they going up well?
This is the key distinction. This brings us to step 3. Filtering for risk-adjusted quality.
Because raw return can be so misleading.
Totally. An asset could be up, say, 50% over 2 years. Sounds amazing. But what if it took a 45% gut-wrenching drawdown to get there?
You probably would have sold at the bottom.
Most people would have. Your conviction is destroyed. So we need a better metric. We need to judge the quality of that return.
And that's where the Sortino ratio comes in. Now, a lot of people know the Sharpe ratio. Why do we prefer Sortino here?
Well, the Sortino ratio is just more intuitive for how investors actually experience risk. The Sharpe ratio penalizes all volatility, both up and down.
But we like upside volatility.
We love it. We want things to go up fast. That's a good thing. The risk we actually care about, the one that causes pain, is the downside risk.
So the Sortino ratio zeroes in on that.
Exactly. You can think of it as the return you get per unit of downside pain. It only looks at the bad volatility, the negative stuff. If you can deliver returns with fewer of those deep, painful drops, you have a higher quality asset.
Okay, so let's say asset A and asset B both return 15% over 2 years. But asset B did it with a much smoother ride, fewer scary drops.
Asset B is the winner. It has the higher Sortino ratio. It's the higher quality asset because it was easier to own.
Okay, that makes perfect sense. But we need a baseline for quality,
Right.
right? A measuring stick.
We do. And that measuring stick is the S&P 500 or the SPY ETF.
Why that?
Because the default option for any investor is to just buy the market index and do nothing else. It's the easiest thing in the world.
So if you're going to do all this extra work,
If you're going to pick an individual asset, manage it, pay attention to it, it had better deliver a better risk-adjusted return than the simplest alternative. Otherwise, why bother?
so that's the hard and fast rule.
That's the rule. Only consider assets with a Sortino ratio that is higher than the S&P 500's over a consistent period, like 2 years.
So at the end of this step, you're left with a short list of assets that are both in an uptrend and are high quality on a risk-adjusted basis.
A very tight, high-quality list. These are your potential team members.
Yeah.
So we've done all this work. We've got a great list of high-quality assets. They're all in uptrends, but
Yeah.
there's a huge hidden flaw still lurking in that list.
This is step 4. And I think this is where the big aha moment happens for a lot of people.
It really is. This is where we analyze correlation to kill hidden concentration.
Because you might feel really diversified. You own, I don't know, a solar energy ETF, a big software company, and a popular fintech name. 3 different things, right?
You'd think so. But if all 3 of them are really driven by the same factor, like low interest rates and a risk-on mood in the market.
Then they're probably 95% correlated.
Exactly. When rates go up, they all fall together. I mean, we had a client run this exact analysis. He thought his 15-stock portfolio was super diversified.
No.
It turned out to be 98% correlated to the NASDAQ 100. He could have just bought one ETF and saved himself a ton of work.
So that's why we need a correlation matrix. What does that show us?
It's a visual map. It shows you which of your high-quality assets move together and, more importantly, which ones don't. It reveals the true diversifier.
The ones that zig when others zag.
Those are the gems. Our goal here is to pick roughly 10 to 15 assets from our quality shortlist that are as uncorrelated as possible with each other.
So if I see 2 assets that both pass my filters, but the matrix shows they move in lockstep, say 90% of the time,
You don't need both. You're just doubling down on the same bet. You only need one of them.
what's the tiebreaker?
The tiebreaker is simple. You keep the one with the stronger Sortino ratio, you keep the higher quality, more resilient asset, and discard the other one.
But what if I do this and realize, wow, my whole list is still pretty correlated. Maybe my initial universe was just too narrow, like all U.S. tech stocks.
That is a fantastic signal. It's telling you loud and clear that you need to expand your universe.
Go find new things.
Go find assets with different fundamental drivers. You need to look at things like long-duration bonds or gold or different commodities, maybe even international markets. You add them to the universe, and then you have to rerun the process on them.
So you run them through the 200-day trend filter and the Sortino quality filter.
Yes, you make sure they earn their spot before they can be considered for the final portfolio. You have to find quality diversifiers, not just any diversifiers.
All right. Got through the whole selection process. We have our team 10 to 15 high-quality, uncorrelated assets. Now we get to what might be the most common mistake of all.
Step 5, position sizing.
So many people get this far and then just equal weight everything, 10 assets, 10% each, done.
And that is such a dangerous, lazy move. It completely ignores risk.
Explain that.
Okay, so if you put 10% of your money in a stable, low-volatility bond ETF, and you put 10% in a really volatile biotech stock, you have not allocated risk equally.
Not at all.
That biotech stock, because it swings around so much more, is going to contribute maybe 5 or 6 times more risk to your total portfolio. It's quietly running the show.
So you're letting one small dollar position dominate your entire portfolio's risk profile.
You are. And that's why we have to switch our thinking to risk parity.
How do we explain that intuitively?
Risk parity just means each position should contribute a similar amount of risk to the portfolio. It's about equalizing the risk contribution, not the dollar contribution.
So there's an inverse relationship with volatility.
Precisely. It's a simple rule. Assets with higher volatility get a smaller position size. Assets with lower volatility get a larger position size.
So that volatile biotech stock might only get, say, 2% of the capital, while the stable bond ETF gets 8%.
Exactly. And the result is that both positions end up contributing a similar amount of punch or risk to the portfolio's overall volatility. It creates structural balance and prevents one name from sinking your ship.
That resilience is the whole point.
It is, and this flows right into the final implementation step. You've now calculated these risk-based weights.
Now you have to turn it into reality.
You translate those percentages into actual trades. If you have $50,000 to invest, you figure out how many shares of each asset to buy to match those weights. This is where the system becomes a real, live portfolio.
Okay, we've built the portfolio.
Yeah.
We have our intentional size positions. The construction is done. But it's not over. We have to move into the maintenance and evaluation phase.
Right. And the first rule of evaluation is you stop looking at the individual assets in isolation.
Because the goal wasn't for every single pick to be a winner.
No. The goal was for the portfolio as a whole to perform well on a risk-adjusted basis. So you evaluate at the portfolio level, you look at the total return, the max drawdown, and most importantly, the portfolio's overall Sortino ratio.
And we always have to compare it to our benchmark.
Always. Your benchmark is still the S&P 500. The ultimate goal is to match, or ideally, beat the SPY on both return and those risk-adjusted stats.
If your super smart, well-constructed portfolio can't do better than just buying the index.
Then there's a flaw somewhere in your process, and you need to find it.
Which brings us to the final piece of the puzzle.
Yeah.
This has to be a repeatable process. The market changes.
This is the real edge. The structure is your edge, not some one-time brilliant prediction. You need a regular loop. You need to revisit the portfolio.
What does that look like?
It means you reevaluate. You might need to adjust weights if an asset becomes way more volatile, but the most critical part is rerunning your filters.
So if one of my positions suddenly drops below its 200-day moving average,
The system tells you to sell.
or if its Sortino ratio falls below the S&P 500's,
It's out. The system removes the emotional guesswork of when to sell. You're not agonizing over it. You just follow the rule.
and then you replace it.
You replace that underperforming asset by running the whole pipeline, again, on your universe, finding the next best, high-quality, uncorrelated name, and sizing it into the portfolio.
So you're shifting your identity from a stock picker who just hopes for the best.
To a portfolio builder who has a defined process for everything, for entry, for sizing, for diversification, and for exit.
Yeah.
That's the game changer.
It really is the power of a defined workflow. That whole pipeline defining the universe, filtering by trend, selecting by Sortino, killing correlation, and sizing by risk, it turns a bunch of tickers into a resilient structure.
It takes all those individual judgment calls and turns them into a measurable, repeatable system. And that system is what gives you resilience when things get volatile.
So as we wrap this up, I want to leave everyone with a final challenge, a final thought.
I like it.
It builds on this idea of being intentional. When you look at your own portfolio tonight, I want you to ask yourself a question for every single holding.
Okay.
Can you explain its job in one sentence? For example, this is my aggressive growth engine, or this is my defensive ballast, or this is my pure diversifier that zigs when everything else zags.
And if you can't,
If you can't, then that position probably doesn't have a clear job in your portfolio.
and if it doesn't have a clear job, you're likely still just running one big bet with a lot of complicated paperwork. The real challenge isn't picking a winner, it's achieving truly intentional diversification and knowing exactly what role each asset plays on the team.